Good afternoon, everybody, and thank you for joining the February version of the monthly market monitor. We'll go ahead and get started right away into some of the most recent economic releases, and we'll kind of break down the outlook on rates and some key indicators in the marketplace that I'm sure you've seen the last few days. Surprised some, maybe not others, but we can kind of dive into what we're seeing in the marketplace over the last several weeks. First thing is the unemployment rate stayed at 3.7%. It was up a little bit from the previous low of 3.6. But again, back 100 years ago when I was still in school, they considered 4.5 or 5% as full employment because there's a certain part of the segment of the economy where people just don't work. So being below quote unquote full employment now for a sustained period of time does point to a very strong labor market. And hypothetically, a very robust and upward surging wages in a way to compete for talent, so to speak. And that's kind of what's happened on the labor side of things anyway. They have to pay up a little bit to get qualified personnel to apply for the job. The labor participation rate, we can all see here from the COVID pandemic, the big correction there, and it's worked its way back up again to 62.5%. But again, it's still below the levels we had pre-pandemic, which was about a full percentage point higher. This does have a lot to do with baby boomers retiring as well. But the unfortunate part of this particular metric is that a lot of the cash businesses, the construction business, some illegal immigrants are paid cash under the table, and those aren't reflected in this particular metric here. And again, that does, kind of inflate wages and depress wages for people in the entry level part of the economy, again, which is a very, very important part of growing the economy. You start out, part-time entry level and work your way up again. But minimum wage, I know there's an effort in California to raise the minimum wage in California from $16 to $20. So the labor component of inflation is a really important metric that is maybe overlooked sometimes, but raising from $16 to $20 an hour for entry level is already $18.50 for a Big Mac meal in California right now. So it's going to go higher than that if they do have a $20 an hour minimum wage for any level of talent. And what that does again is increases wages for managers. They claim that I should make more than $1 an hour more than an entry level, line cook. You got to give them more money too. So it's kind of a feedback loop, adding more and more to the labor expense and ergo some of the inflation metrics that are out there. This is another reason to maybe not be so optimistic about the labor market. This shows multiple job holders out there is driving up. I guess the jobs numbers look really good, but when you dive deep into the numbers and see that people are picking up second jobs as a way to make ends meet because of the embedded inflation metrics, we've seen over the past 2 or 3 years. Now, inflation is down from its peak, but still you had, a 9-10% increase on top of a 7% increase. So there are some items that are 25-30% higher in price than they were 2 years ago. And those prices have not come down. So it's another way of saying that some of the high price increases we saw have been embedded in the marketplace and are likely here to stay. Again, this is another way to show it, that the unit labor costs, again, showing that the inflationary pressure of the labor portion of the economy is going to stay higher than it's been in previous cycles. Again, this is the forecast. So you see that light blue line on top, that is a core consumer price index, the CPI number. And you can see at the start, end of 2023, early 2024, it was right at 4%. And those of you who attend these calls, on a regular basis know what I've said in the past is that it's argued that it's harder to go from 4 to 2 than it was to go from 8 to 4. So again, the really long pants have to come out, and you really have to sharpen the pencil to drop it farther down to the quote unquote target of 2% interest rates. And that's what we've seen so far. because we've been around 3% with a lot of leading indicators, whether it's the PCE, which is what the Fed's preferred metric is, CPI, PPI, more of a producer price index, which is more of a wholesale metric, and it points, inventories, and you can forecast what prices will do. But ultimately, it's just a forecast as to where they're targeting inflation will come later in the year. But still, the core CPI number is still above where it wants to be. The Fed wants 2% target. It's still north of 3%. Now, this is the so-called super core. This is what kind of surprised to the upside yesterday in some of the inflation data that came out. You can see the super core, again, which includes things like getting your haircut, medical expenses, office personnel, transportation services, things like that, Uber, a cab. So you're middle of the road type of service-oriented things in the economy. And it's the highest level we had since September of 2022. So this is pointing towards a risk of a reflation or maybe of a flattening of the downward trend in inflation. And the Fed came out, yesterday with some of the prints that happened, and now the forecasters are probably pushing back their expectations for the Feds to cut rates. Some had forecast by the March meeting, some had forecast by the June meeting, but now it looks like almost all forecasts now are kind of off the table as more data comes in the coming weeks about what to do. And we'll see with labor inflation, with commodities inflation. As we all know, it's a little hairy in the Middle East right now, especially around the Persian Gulf, with the Houthi rebels firing on tankers, oil tankers. They had to go around Africa. That adds a lot of the freight costs as well. And if energy prices go up, even though energy prices are stripped out of the core number, we all know that inflation is really pervasive if energy costs are higher, because it's a feedback loop that goes through almost every portion of the economy. So there are real political risks as well, and that's something you can't measure, unfortunately. The political risk of energy prices going up and commodities prices going up, which would be really inflationary risks we face, in the coming, I guess, the coming months, really, because this is something that's very pervasive in the marketplace. Other metric that I thought was interesting is the median CPI number. Again, this is much higher than their peers, and this is indicated by the orange line on the chart here. And you can see that, in the years leading up to the COVID pandemic, that was the highest of all the metrics. And then it came the lowest, and now it's back to the highest again. So it's almost like they regress to the mean, so to speak, the median CPI number, which is a 1 month inflation rate of the component whose expenditure weight is 50%. So again, it's a long way of saying there are many things that are thrown into the bucket that comprises the median consumer price index. This is the one right in the middle, the 50th, right in the middle, and the expenditure weight is 1/2 of the component, 50% of the component. So it's really like the previous slide I showed you, the super core, really the middle class type of consumer prices. It takes out the yachts, it takes out the private jets, it takes out the big, manufacturing equipment for $1 million, $3 million. This is your meat and potatoes type of consumer prices that everybody, your typical, citizen or typical American would face. And it does show that inflation is leveling off, and it's still well above the rate that the Fed had targeted, which is 2%. Again, the urban CPI number, this is what surprised the upside yesterday. You see the print here at 3.1%, and that was expected to come in lower than that. So this is part of the reason that the yields kind of went, there's a big sell-off in the market. Yields are up 25 basis points across all of the curve, 1 to 5 years. And we settled down to about 10 or 12 by the end of trading. Today, it gave back a little bit of it, maybe 3 or 4 basis points, but still, it spooked the market very precipitously. And what we kind of draw attention to, unfortunately, is that a lot of the things in the super core are not necessarily loan dependent. Those service sectors are not loan dependent. And the headline numbers we typically see from banks and all the rest of it is that, banks leverage people's money, and there is a market price for a cost of funds that is measured. The Fed funds rate is X. the overnight repo rate is Y. Therefore, my cost of funds is somewhere in the 5% range. So in order to get a risk-adjusted return that's worthy of investment, you need to have 12%, 8%, 6% return, whatever it is. So, and those are big, big money movers, hedge funds and managed funds throwing money around, and big manufacturing stuff who have high leverage. The energy sector has high leverage as well, and expensive commodities prices involved. Those big ticket items drive the needle a lot, but like I'm saying, the numbers this time around are really pointing more towards the middle class, and that inflation may be embedded more than the Fed expected. And again, it put the brakes on a lot of their forward guidance on their rate paths going forward. Core services, again, the 3-month and 1-month averages, you can see they are surprising to the upside after having a big correction in 2022. But again, the reflation risk is real. And I'm sure the Fed is paying attention to these numbers because this kind of flies against their general tendencies as, first it was transitory, then they kind of got a little bit late to raising rates. And now some say they raised rates too fast. You're up 5+% in a matter of 18 or 20 months. That's going to kill economic growth. Maybe it did, but surely the cost of capital is very expensive, and new home sales are starting to suffer a little bit. We'll get into that a little more, but again, these inflation metrics are nothing that the Fed can ignore. Again, this is inflation and core inflation. You can see that they've kind of bottomed out, and perhaps the bias is back up again. The black line, the core inflation, is higher than regular inflation, and that's the first time in a couple of years now. But 11 months straight, core inflation rates have exceeded inflation, and one of these two are going to go up, or are going to regress to the other, though. And it's likely inflation moves up to meet core, not the other way around, down, because it's a more volatile metric. And but it's certainly something that you got to pay attention to going forward. Again, this is the business of forecasting interest rates. You can see the dark line, the thick line is what the actual rate was, and all those little lines are what the market analysts predicted. And you can see how far they deviate from reality. So it's a difficult thing to predict rates, and just be careful with that. Budgets are always meant to be, versus budget versus last year, and your delta. Is a big delta built into the rate forecasting business, and this is shows to it because these are the most highly educated economists in the world, and they're wrong most of the time on their forecasts. So just keep that in mind when someone's telling you about what rates are going to do, because maybe they know, maybe they don't, but it points towards some hubris, maybe in order for some of the big analysts out there. Money supply growth. Again, inflation is everywhere and always a monetary phenomenon. Milton Friedman, and again, this is one of the tenets of the University of Chicago. And if you're an economist educated there, money supply is the end-all, die-all metric beyond that drives inflation. So it's been that way for a long, long time. It's kind of what they're known for in the academic world of inflation. So the money supply, you can see the peak in 2021 and where we come, and the quick supply change of M2 money supply, again, was the checking, savings, money market deposits, et cetera. There's a list there of what's included in the M2 metric. And if you go back over a couple of 100 years here, it's interesting to show how fast money supply has come down, and there's never been a good thing that happened after that. You can see the Great Depression on here is actually one of the more passive corrections we've had, dating back to the 1850s, 1870s, when the money supply changed. This particular money supply change is about the same as it was during the Great Depression. And again, that led up to World War II and big expenditures there to fight that off. So the COVID pandemic was, looking back in history, was maybe a bit of an overreaction as a part of throwing money around, trying to cure everybody's ills, metaphorically and fiscally. But maybe it wasn't the best remedy, unfortunately, based on the fallout we've had with inflation pressures. And now the baseline budget is higher than it was because of extraordinary funds. And now we can't really get back our fiscal house in order, unfortunately, in Congress. So despite all of that, those headwinds, the economy has been pretty strong, really, despite all the rate hikes we've had the last couple of years, 5.25%. So again, the GDP forecast is expected to be, between 2 and 2.5%. Again, so anything positive is good, right? Again, people can argue for 4% GDP growth should be very attainable in the right tax environment and labor environment, et cetera. But it's still a 2% growth rate is pretty good given the headwinds we've faced. And this is kind of lends credence to the soft landing folks out there saying the labor market in the GDP growth shows that we've persevered through all the hardship. Again, the S&P number with all the optimistic is really, really up. I know the stock market took it bad yesterday, got a big correction, but the S&P number since October is pretty strong, actually. It's given up a lot of the gains since it has since January in the last couple of days of trading, but still the S&P 500 is pretty strong. So the equity trades, given all the excess funds out there, institutional money, is driving up stocks and everything else. Interesting stuff here too with delinquency. Credit cards and other loans, you can see are the highest they've been since 2010. And again, the trend is your friend. In this case, it's not, because it's trending in the wrong direction for delinquency. So, credit card delinquency, again, is something to keep an eye on because it's unsecured and there's massive write-offs. And we're coming off low rates, I guess. I know credit card rates are still 18%, even when Fed funds was 0. So there's plenty of margin there. But I know they paid their expenses in previous years and the carry forward is less than it should be. Again, this is something we look at frequently as an ABS buyer. We typically buy prime only at Corporate Central for our bond portfolio because the volatility is so much less and the extra yield you get for subprime, this isn't worth the risk in many cases. And you can see here delinquency on subprime loans versus prime loans is pervasive and very noticeable. But again, this doesn't mean that you should exit the subprime lending space. It's just risk reward and pricing that appropriately. And unfortunately, what we're seeing, and many of you maybe can attest to this, is 2020, 2021 loans that were issued at rates well below what they should be based on the credit risk. And now, the rates are up 5%, and suddenly you're upside down. You're funding your loan portfolio with a 3.5 handle on a 620 FICO, and that's not priced right based on the risk. Vehicle loan growth, you can see this, the seasonally adjusted annualized growth rates. So vehicle loans are well down, which is unfortunate because now is the time to be making a car loan. If you can make one in 7-8% instead of 3 or 4%, that's good, right? Cost of funds, I know that most share rates haven't gone up a lot. Money market rates have responded maybe 3.5-4% in some places, maybe higher than that in a couple other banks out there. But still, the cost of funds is pretty low on share rates. So the overnight margin is pretty strong on cash. And maybe there's taking that and riding that instead. But it's a good time to make a loan rate, especially to prime borrowers now, if you can get even a 6% loan on a prime borrower. But does so the growth rate is down here. You can see all this particular crisis. This is going back the size of the balance sheet. You can see all the pandemic spending, the big inflation, Silicon Valley Bank, and some of as the Feds try to wind down their assets. Still, the good times are about half what the balance sheet is now. So there is still some work to do to get, quote unquote, back to the good old days of just the Federal Reserve Bank managing rates and not necessarily managing the size of a balance sheet. But again, like we warned back then, once you open up Pandora's box and do this, it's likely never going away. So the Fed can control interest rates more with the size of the balance sheet and buying securities, buying treasuries, or selling them than they can be by signaling a Fed funds rate, a repo rate, etc. So it's a tough pill to swallow now, knowing that perhaps interest rate is the secondary effect on affecting liquidity, affecting the marketplace, and it is just the size of the Fed's balance sheet. Again, you can see the discount window access, Silicon Valley Bank panic. Again, they didn't have the U101, the term funding program yet. So you take note of that panic, about $150 billion of that particular advances. And you can see here we're up to 160. This is on the U101 advance. So this was kind of thrown together and thrown out to the marketplace the weekend after Silicon Valley Bank failed. So a lot of advances in that particular funding program. You can see it's very, very high in advances, and the risks are now is probably commercial real estate. I know a lot of regional banks have commercial real estate exposure and have taken down term funding loans, for liquidity management. But this is something very serious. And the Fed did have guidance a couple of weeks ago that the arbitrage opportunities are not going to be available. So they changed the metric in which that loan advance was priced. It used to be based on 1-year swap rates. Now it's equivalent to the reserve rate. So the opportunity to borrow and put the money at the Fed and make a spread on it is gone because your cost of funds is the same as your yield on your cash. So they're saying they're mitigating the risk of arbitrage, taking advantage of arbitrage. The Realtors Index, again, housing affordability. This has a lot to do with just not many homes available for sale and the high interest rates. So the affordability of this metric is very, very low. The lowest has been since, it looks like it's been a long, long time, since the 80s and 90s on affordability index on this particular metric. So high rates, high prices, low wages on new income, on new people entering the workforce are all contributing factors to that. Existing home sales 2023, the red number you can see is down and declining. 2022 is a little bit less than that, but you can certainly see the trend here on new existing listings, and that it's on the way down. And people can't afford them anyway. But the listings, the ages on listings, the days, I think it's close to a 45-day average now that homes are listed. These were printed yesterday, so this is the change in yields month over month. You can see 50 basis points on the 2-year part of the curve, 10-year 36 basis points. So big swings to the upside on yields. And it wasn't all yesterday, although yesterday again was maybe 12 to 13 basis points by itself when it did these prints. So certainly the market was listening to the risks yesterday. This is the forward guidance on the rate cut. Just a couple of days ago, that June 12th meeting had over a 100% built in that the Fed were going to cut. Now it's 58%. So, saying about more than half people think that the Feds may cut rates in June, but there's certainly not a consensus now that the Feds will cut rates. So that one print of CPI number yesterday, surprise to the upside, and all the super core stuff we talked about being high, that kind of pumped the brakes on the Fed's outlook on rates. 2-year Treasury yields, again, up yesterday, but they have corrected today. You can see they're coming in now still under 5%, and 10-year yields well under 4.5%, but well south of 5%, where they touched early, actually late last fall, and they have rallied since then and come back again. But still, the 10-year Treasury, even if the Fed rates drops overnight rates by 50, 60 basis points, that would take you down to like the high 4s on cash. You would think if you want an inverted curve again, that means that the 10-year would be 4.5 or 5%. If cash is 4, you want to have some slope in the curve, and we've gotten maybe so used to this inverted yield curve. It's been over a year now that the 2 has been higher than the 10-year on yields, and cash has been higher than the 10-year on yields. It doesn't incent anybody to go long on their liabilities again, or long on assets and invest, because the return's lower than it is in cash. So it keeps everybody kind of tempered and close to the vest, unfortunately. Again, these are just some generic prints. New production 15-year paper, 85 over the curve. That's that little yellow box on the left. At that speed, 182. And again, not trivia question, but all the speeds across on this metric, none of them are right. They're all just modeling what they might be, what yields might look like if that speed took on this pool of loans over the period of the 15-year term. So just take that for what it's worth, but none of those forecasts are accurate. It's just a kind of a benchmark as to how it will pay and what yield you'll get relative to the spread as it shortens and extends based on cash flows. Same 30-year paper. This is a 5.5-year. And again, I just picked ones close to par on purpose. There's not a big variance here on spreads. There is, from 1.72 years to 7.69 years in the down 200. But new production 5.5s are probably 6 handle 30-year mortgages. So again, they're really price sensitive 30-year mortgages. So if rates do drop 1 or 2%, the refinances will likely be very, very fast. Ergo, the 869 prepayment assumptions on down 200. So bear that in mind as well, how price sensitive 30-year paper is, and maybe a bigger discount in a better move for you. So that's all I have for today's call. Wonder if anybody has any questions or comments for myself or anybody else. Okay, I see no questions on the Q&A tab. So that concludes the meeting for this month. Thank you all for attending, and we will see you in March.